This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, August 11, 2026, and this is the After Hours session. Now, let's get into it. The global risk register is flashing red. The fear and greed index has plummeted to a deeply fearful 14 out of 100, signaling a severe retreat from risk assets. In this environment, the Australian dollar is bucking the trend, holding steady at 0.70577 despite the chaos, while the Japanese yen faces immense pressure, with dollar-yen climbing to 159.1925. Welcome to ShadowQuant Forex Edition. We are live from the post-close desk. The headline here isn't just the fear, it's the divergence. We have a reserve bank, the Reserve Bank of Australia, that has just held rates at 4.35% and explicitly flagged the scope to hike again. That is an incredibly stubborn stance in a world where the broader market is screaming for relief. Meanwhile, the U.S. Federal Reserve is staring at a CPI print of 3.46% and core PCE at 3.29%. Both are far above the 2% target. So we have a scenario where the Aussie Central Bank is talking tighter, and the American Central Bank is stuck on hold because inflation won't die. That creates a massive policy wedge.
And that wedge is visible right now in the price action. Look at Aussie dollar. It is sitting at 0.70577. On the daily chart, that is a firm hold above the intraday low of 0.70512. But notice the ceiling. We hit a 5-day high of 0.7078 earlier this week and got rejected. The pair is currently oscillating in a very tight box between that low and that high, technically. The hawkish hold hasn't sparked a breakout, it has just created a floor. The market is absorbing the Reserve Bank of Australia news and consolidating. There is no momentum here yet, pulse. It's a range-bound defense.
I want to look at the plumbing behind that defense. The CFTC commitment of traders data tells us why Aussie is holding and why yen is getting crushed. We see leveraged funds holding a net short position of negative 60,825 contracts in the Japanese yen. To put that in perspective, that is a week-over-week increase of negative 61,403 contracts. That is an extreme concentration of shorts. The market is betting heavily on the yen staying weak, and they are piling into it. Conversely, look at the British pound. Leveraged funds are net long plus 38,174 contracts, adding 37,416 contracts this week. There is clear institutional conviction building in pound, which is helping stabilize the broader risk-off sentiment for non-US currencies.
But CIPHER, you're describing a loaded gun. A week-over-week jump of negative 61,403 contracts in short yen positions. That is unsustainable positioning. And here is the risk. The VIX is sitting at complacent 14.9, while the fear and greed index is at 14. We have a massive dissonance. The equity market thinks everything is fine, but the currency traders are shorting the yen into a geopolitical firestorm. Oil is surging because Iran keeps the Strait of Hormuz shut, and new Gulf attacks have resumed. When that volatility spikes, and it will, it doesn't matter how many shorts you have, you will get squeezed. The technical level of 159.1925 for dollar-yen is not a trend. It is a liquidity trap waiting to snap shut.
So we have a situation where the fundamentals are pulling in three different directions. Pulse identified the Reserve Bank of Australia's aggressive stance supporting Aussie. Grid showed us that Aussie is hitting a technical wall at 0.7078, and SPECTER warned us that the yen short squeeze is imminent due to the massive COT buildup. My read is that the Aussie strength is fragile. It's supported by policy, yes, but if the broader risk-off trade accelerates, as suggested by that Nasdaq leading decline of minus 0.6%, we might see Aussie break down through that 0.70512 support. We aren't seeing a clean breakout yet.
Let's dig deeper into the Japanese yen, specifically dollar-yen. It is trading at 159.1925, up 0.2%, hovering near its 5-day high of 159.366. Why is the yen being sold off so aggressively despite the global fear?
Structurally, dollar-yen is testing the upper bound of its recent expansion. It closed at 157.78 on August 9th, and now we are pushing 159.19. The key level to watch is that 159.366 high. We haven't cleared it decisively yet. Usually when a pair tests a 5-day high repeatedly without a sustained close above it, it indicates distribution. The buyers are stepping in, but the sellers are overwhelming them at the top. I am looking for a rejection here. If we fail to break 159.5, we are likely to see a mean reversion back toward the mid-range average of around 158.5.
Grid is looking at the chart, but he's missing the yield curve dynamic. The 10-year yield is at 4.72%, and the 2-year is at 4.25%. That spread is flat. A flat yield curve is a classic precursor to recession. Yet dollar-yen is rallying. This implies that the market is not pricing in a soft landing. It is pricing in the fact that the Fed cannot cut rates because of that sticky 3.46% CPI. The carry trade is alive because the differential is still wide enough to justify the risk, even if the macro backdrop is deteriorating. The Reserve Bank of Australia hiking to 4.35% actually reinforces this. It makes the dollar/Japan carry look even more attractive compared to other majors.
And that carry trade is exactly what is causing the danger SPECTER mentioned. The net short of negative 60,825 yen contracts means that every hedge fund and speculator is riding the same side of the boat. When dollar-yen stalls at 159.19, those shorts start to lose margin. They don't have an exit plan. They are trapped. I'm seeing the DXY futures positioning turn sharply positive with a net of plus 4,438 contracts, even though the broad trade-weighted dollar index is down 0.45%. Smart money is front-running a dollar surge. They know that with the Reserve Bank of Australia holding and the Fed stuck, the dollar has nowhere to go but up against the yen, unless the Bank of Japan steps in.
Unless the Bank of Japan steps in. That is the black swan here. You have a net short position of negative 60,825 contracts. That is essentially a vacuum ready to implode. If dollar-yen touches 160, or if the VIX spikes above 18.43, which it currently isn't, thank goodness, the entire short book gets liquidated simultaneously. Grid talked about a rejection at 159.366. I'm telling you that rejection will be violent. It will not be a gentle drift lower. It will be a spike. The low VIX of 14.9 is giving everyone a false sense of security. The risk is skewed entirely toward the downside for anyone holding those yen shorts right now.
Shifting gears to gold. Gold is trading at 4,419.49, up 0.39%. We saw a 5-day high of 4,435.4 recently. Is gold continuing its safe haven rally?
Gold is certainly holding its ground. It closed at 4,402.33 on August 10th, and we are now at 4,419.49. The support level here is robust. Even with some profit-taking, it hasn't broken below the 4,400 psychological mark. The 5-day range is wide, stretching from 4,223.45 to 4,435.4, but the current price action suggests that buyers are defending the mid to upper end of that range. We are seeing consolidation just below the 4,435 peak. Until we see a daily close below 4,402, the uptrend structure remains intact.
Positioning supports this. Gold CFTC data shows leveraged funds are accumulating longs, though less aggressively than the yen shorts. But more importantly, look at the correlation with dollar Swiss. Dollar Swiss is at 0.810225, approaching its 5-day high of 0.81359. When the Swiss franc weakens against the dollar, gold tends to find support in local currency terms. The institutional flow is rotating out of European currencies and into dollar and gold. We see a net short of negative 52,205 euro contracts, and a net short of negative 101,748 Canadian dollar contracts. Capital is fleeing fiat exposure and parking in hard assets. That is why gold is holding 4,419.
It's the inflation data again. Core PCE at 3.29% is the anchor. Investors are worried that central banks cannot bring inflation down to target. When you combine that with the fear and greed index at 14, you get a perfect storm for gold. It's not just a safe haven, it's an inflation hedge. The Reserve Bank of Australia holding at 4.35% confirms that globally, prices are sticky. So gold at 4,419.49 isn't just reacting to geopolitics. It's repricing the purchasing power of the major currencies. The market believes the Fed is behind the curve.
So we have gold defended by inflation fears, yen being crushed by carry trades, and RC being propped up by Reserve Bank of Australia policy. Let's look at euro-dollar. It is at 1.15433, down 0.2%. It is pinched tightly within its 5-day range of 1.15147 to 1.1581. What is happening here?
Euro-dollar is the definition of compression. It is trading almost exactly in the middle of its 5-day range. At 1.15433, there is no direction. The volume profile is thinning out. Typically, when a pair compresses this tightly, it precedes a breakout, but not necessarily a sustainable one. Given the negative COT positioning for the euro, net short negative 52,205 contracts, I would bet on a slow bleed lower rather than a sudden explosion upwards. The path of least resistance is toward that 1.15147 low, simply because there is no buyer interest at the higher levels.
And that low of 1.15147 is the cliff edge. If the USCPI data comes in hot, which the market is waiting for, that support will vanish instantly. The COT shorts are already in place. The only thing stopping a collapse is the hope for a dovish surprise from the Fed. But with CPI at 3.46%, that hope is fading. I'd be wary of any bounce here. It looks like a bull trap.
Let's talk about the British pound cable. It is trading at 1.3511, effectively unchanged on the day, but we noted a 5-day high of 1.35308 and a low of 1.34343. CIPHER mentioned strong COT longs for sterling. How does that translate to price?
The COT data is unequivocal, plus 38,174 net contracts, with a weekly addition of 37,416. That is aggressive buying. Unlike the yen shorts, which are crowded and dangerous, the pound longs are backed by a narrative, the Reserve Bank of Australia hold, and general UK resilience. Institutions are loading up because they believe cable has room to run toward that 1.35308 high. They are not chasing a dead cat bounce. They are betting on sustained strength.
Technically, 1.3511 is resting just below the 1.35308 resistance. It's a test. If cable can close above 1.353 on a daily basis, the door opens wider. Right now, it's tapping the ceiling. The volume isn't quite there to smash through, but the order flow from COT suggests the buyers are patient. They are willing to wait for the pullbacks to buy.
Be careful, grid. The Reserve Bank of Australia hold helps pound indirectly by stabilizing commodity currencies, but the UK economy itself is struggling. The broader global risk-off sentiment is a headwind for all G10 currencies except dollar. The reason pound is holding is that the market expects the Bank of England to also stay higher for longer, similar to the Reserve Bank of Australia. It's a game of whoever blinks first. Between the Bank of England, the Fed, and the ECB, the pound is caught in the middle. The COT longs are good, but they are fighting a stronger dollar trend. Finally, let's touch on dollar CAD. It is at 1.3931, down 0.2%, near its 5-day low of 1.39256. The headline notes that Canada is trying to close a trade deal with the Trump administration. How does that impact the loonie?
The COT data paints a grim picture for the Canadian dollar. We have a net short of negative 101,748 contracts. That is the largest net short position across all the currencies we discussed. Institutional money is betting heavily against Canadian dollar. The trade deal narrative might provide a temporary floor, but the positioning suggests that structurally, the market expects the Canadian dollar to weaken. The 1.39256 low is being tested, and the shorts are eager to push it lower.
At 1.3931, Canadian dollar is flirting with its 5-day low. If that 1.39256 breaks, we could see accelerated selling. The technical setup is weak. There is no support structure above this level to absorb sells. It's a straight line down from the highs with minor pauses.
Remember the oil context. Oil is settling higher as Iran keeps the Hormuz shut. Typically, higher oil helps Canadian dollar. But here, the risk-off sentiment is overriding the commodity link. Everyone is selling Canadian dollar regardless of the oil price because the broader fear is dominating. If the oil surge continues, Canadian dollar might find some life, but right now, the shorts are in control. Watch that 1.39256 level. A break there confirms the bearish trend.
To synthesize what we've heard, the market is fractured. The Reserve Bank of Australia's hawkish hold has isolated RC, keeping it stable at 0.70577 despite the broader fear, but Grid warns that RC is hitting a technical wall at 0.7078. Yen is being mercilessly shorted, with COT data showing a net short of negative 60,825 contracts, creating a massive squeeze risk if dollar-yen stalls at 159.1925. Euro-dollar is compressed and vulnerable, with Grid noting the 1.15147 low is the likely next target. And finally, Canadian dollar is being hammered by institutional shorts, negative 101,748 contracts, ignoring the supportive oil price due to overarching risk aversion.
That brings us to the key takeaways for today. First, the Reserve Bank of Australia's decision to hold at 4.35% and flag potential hikes is providing a unique pillar of strength for Aussie, but technical resistance at 0.7078 limits upside. Second, the extreme short positioning in yen, negative 60,825 contracts, creates a volatile environment for dollar-yen, especially with geopolitical tensions in the Middle East driving oil prices higher. Third, euro-dollar is consolidating in a tight range, with downside risks increasing as the broader market awaits USDJPY data. Tomorrow, all eyes turn to the USDJPY release. As always, monitor your risk management. This is ShadowQuant Forex edition. Thank you for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.